by gapping above yesterday's high. We're gapping above last week's high, and that creates a gap up on the weekly chart. But whenever a gap is small, it usually closes pretty quickly. I don't think it matters if you have a small gap that closes or a small gap that stays open. A big gap is more important than a small gap, and a small gap usually closes, so the odds are this will close as well. We had two strong days on Thursday and Friday, and that made it likely that we would get above Friday's high at some point today. A lot of times what happens is when you get buying into the close like that on Friday, traders hold over the weekend, and they hope to get a big gap up. And if they get a big gap up, they'll wait. And if it goes up more, they'll hold and they'll make a lot of money. If you get a small gap up like this, a lot of times they'll be disappointed and they'll sell. A lot of the selling that's taking place right now is from the bulls who bought the final hour of Friday, who were disappointed by a small gap up. It's interesting. We have another bar here on the open where there is no tail on the top of the bar. You know, we had that last week, and that usually means that the market has to get above the high of the bar. So, one of the days last week we had that on the open. I don't think it was here. It might have been here. And then when we looked at the CME, there was actually a tail on the top of the bar. And you can see TradeStation put the tail up there now. They fixed it. They would not fix it during the day. I tried reloading it repeatedly, and it did not work. And sometimes they fix things after the market closes. In any case, we've had a 2-day strong rally, small pullback, a very tight channel, and that is unsustainable and climactic. Therefore, the odds are we'll have at least a couple hours of sideways to down trading today. It's possible, as I said many, many times, that the weekly and monthly charts are historically overbought. They probably cannot get much more overbought without getting a correction, and therefore it can begin at any time. And I've mentioned that we've been getting some selling early on over the past couple of weeks on the open, here and here and here, which is different, bigger selling, stronger selling, and from what we've been having over the past several months. And that is a sign that the market might be transitioning into a trading range. Yet we just keep going up and up and up. Monthly chart, this is a weekly chart, monthly chart, 12 months without a pullback, historically overbought. It's only happened once, probably in the past 50 years in the S&P. And the longest that it ever was in those 50 years was 13 bars. So in other words, one more month, and this will be the longest in history. So unlikely to continue much more without at least a small pullback, 1 bar pullback, 2 bar pullback. The odds are against a reversal down without at least going sideways for a few months. Weekly chart has not touched the moving average in 49 weeks, and that has never happened in the E-mini. We got close here but did not get there. And because it's so unusual, it's unlikely to continue much longer. So the odds are we have to get down to the weekly moving average. We can get there simply by going sideways or by going down. You can see we closed the gap, and what happened? They bought. So there were some bears who sold immediately on the open, looking for a test below yesterday's high. They were thinking that the gap is small, and therefore is likely to close early on before the market gets much higher. So they sold. As soon as they saw a relatively small gap up, they just sold for a scalp. I could draw channel lines in. Usually when you have a buy climax, we had one here, you have about a 25% chance of follow-through buying on the open, did not get in on Friday, and you have a 25% chance of a big bear day, did not get it. 25% chance of a big bull day, did not get it. And 75% chance that the market's going to go sideways for at least a couple of hours, beginning by the end of the second hour. Here we went sideways for about 3 hours right on the open. And the same is true today. Yesterday was Friday, was again a very strong bull trend, and the odds are that it'll be have more trading range trading today. Bulls hoping that this one bar sell-off is simply a test of support, yesterday's high, and that we reverse up here on the open. So they want an opening reversal up and an early low of the day. I'd have to check the CME chart, and all I have is delayed CME data, so I do not yet know if the high of the day is, as it appears here, right on the open. On the daily chart, if you look back over the past year, you might find maybe one day in the entire year when the high of the day was exactly at the open of the day. A lot of days, not a lot, but maybe 5 days or so a year, the open is on the high of the day, but the market then trades above the high, and on the daily chart, the open is no longer at the high. So right now, the odds are that, assuming this is correct, we don't yet know that it's correct, but assuming the open of the day is exactly at the high of the day as it appears here, chances are we'll get above the high of the day. Okay, there's a problem with cash in TradeStation. You can see data request failed. So I may have to restart TradeStation in a little while, but I'll keep the webinar going. I'll just restart the TradeStation. TradeStation, the current release, I think, is buggy, and I think it's causing crashes. I've had a lot of problems with the data cache on both of my computers since this new release came out, and therefore I think it's I suspect that there are other problems with it as well. There are other problems with option traders. There are problems that I told them about. All right, so are we always in long yet? Always in short yet? Well, I usually like to see 2 bear bars. Sometimes 1 bear bar will do it if the context is good, but even with 2 bear bars, this is a very tight rally. It might take 3 or 4 bear bars before traders believe that the market's going to reverse this. Usually when you get a strong breakout, especially a surprise breakout, and this was surprising, you get at least a small second leg up. And today's open was a continuation of the first leg up. If it's always in short, if traders believe it's always in short, if traders believe it's the start of a bear trend, they'll sell closes. And I think because this surprise reversal and breakout was as strong as it is, traders are not going to sell the close of 2. They're also not going to buy it. If you have consecutive bear bars, the odds are there are sellers above. The bears have a better chance if 2 is a big bear bar closing on its low. We have less than a minute to go. It does not look like it's going to be a big bear bar closing on its low. It still could be a bull bar. It's very common, especially in the first hour, for a bar to look one way and then in the final couple seconds look the entirely opposite way. So in other words, it can be a bear bar, and then with 2 seconds to go, all of a sudden it has a 2-tick bull body. And at the end of the day, you just assume that it was a bull bar, for most of the bar. But watching it real time, it was just suddenly became a bull bar. A bunch of institutions bought, and the bear bar reversed into a bull bar in the final 2 or 3 seconds. Not likely to happen. Usually, if it's a bear bar through most of the bar, it stays a bear bar. Okay, so consecutive bear bars closing on their lows. I think it's tough to call it always in short because of how tight this is. A lot of times you'll get a strong rally on the close and a gap up, and then a very deep pullback, and then a rally attempt, and that's what usually happens. This is a small version of it. This is a bigger version of it. Gap up and very deep pullback. We had an even bigger a few weeks ago. Here's kind of thing. Gap up, very deep pullback. Never fell to below the bottom of the bear leg, of the bull leg, and we got a wedge bottom, 1, 2, 3, and a reversal up. Another version, gap up, bear bars, and fairly deep pullback beyond 50%, and formed an opening reversal. Same thing here. This is similar to today as well. Strong rally, gap up, a lot of bear bars, but could never fall below the bottom of the bull breakout, and formed an opening reversal. Here we had a double bottom, but it was still an opening reversal. And right now the odds are, even if we get a lot of bear bars, we'll get a higher low and an attempt at an opening reversal. The bulls needed to stay above the 78 low for that to play out. So the bulls are hoping that whatever sell-off we get is a bull flag. In other words, that it stays above this low and that it leads to a reversal back up. Every bear bar that we get reduces the probability for that, but unless the bear bars are really big and unless we break strongly below 78, that is more likely than a reversal into a bear trend. A little bit of spike pullback channel. So the bottom of the beginning of the channel is often a target. It's also around the moving average, and it's also around these breakout points. And we're stalling. We're around a 50% pullback right now. So there are different support things here. 50%, the breakout points, the beginning of the channel, the moving average. Yesterday's high. So a lot of little support things going on here. I don't even have yesterday's high drawn in. I'll put that in here. Actually, I do have it. This is yesterday's high, obviously. Bulls trying to get the opening reversal, but with the two bear bars closing near their lows, the odds are there'll be sellers above. And we went sideways here for 3 bars. We're in a support area. Let's say bar 3 has a 3-tick bull body or a 4-tick bull body. Then we might get above the high of the day before we start to go sideways. But the odds are that we're not going to go right up into a bull trend from here. Too much of big up, big down, big confusion, and therefore sideways likely. Even if we get above here, sideways likely. Like here, consecutive bear bars, and we got to a new high, but still went sideways. There were sellers above the high, and that's probably true here as well. I'm going to turn the screen off for a second, and I want to check the let me check the CME website. Yeah, the chart is delayed, and they do not yet have the day session open yet. I want to find out if the open is actually at the high of the day, and I cannot tell yet. All right, so 3 consecutive bear bars, so we're always in short. I think there are sellers above, but I think that we're probably going to get a bounce soon. Is it sell to close? If you're willing to put a stop above the high of the day and scale in higher, then probably sell to close. And if you get stopped out above the high of the day before we get a test back down, you sell again on a reversal down. So not a very good buy. Sorry about that. I just noticed that the screen was off. So I'm not sure if the bugginess is go to webinar or TradeStation. I think both have had a history of problems with their software. All right, so do the bears sell here or do they sell higher? Both. They'll sell here, they'll sell higher. And do the bulls buy above 4 if it's a bull bar? They might, but this 3 consecutive bear bars, big up, big down, probably going to be sideways. So, I think more likely there are sellers above 3 and sellers above 1. Here you can see sellers above 3. A lot of days over the past several months have had sell-offs on the open, and sometimes they've lasted 2 or 3 hours. But almost every one of them was bought, and it led to a rally lasting 2 hours, 3 hours, sometimes 4 or 5 hours. And therefore the odds are against any sell-off leading to a big bear trend day. The bulls keep getting reversals. Sell-off, reversal. Sell-off, reversal. Most of the reversals lead to trading ranges. They don't break strongly above the high of the open. Sell-off, reversal. We got a little bit of a high, but not a strong bull trend day. We got a bull leg and basically a trading range day. Sell-off for a few hours and reversal for a few hours, but did not break strongly above the high of the day. So basically, it's a trading range day. And today is looking like that. You can see we're in a tight bull channel for 2 days. It's unlikely that today's going to become a bear trend without getting a major trend reversal, which means it has to go sideways. It's possible that this is a final bull flag and this is a breakout to a higher high major trend reversal, and then we get a bear trend down. But overall, the channel, I think, is very tight, and we probably have to go sideways for a couple of hours before the bears have a reasonable chance at a bear trend day. So it looks like trading range open. Disappointing open for the bulls. We have a buy climax, 2 days up in a tight bull channel. Usually a buy climax leads to a trading range. And we have the 3 bear bars, usually leads to a trading range. And very tight bull trend, unlikely to become a bear trend without going sideways for at least a couple of hours. Right now, always in long or short. I think technically I'd say it's always in short. We have a pair of decent bear bars, so probably bear selling above 3. But because it's a trading range open and because 1 opened on the high of the day, we may have to go above 1 before the bears can get a reversal down. I'm looking at the I don't know what's wrong. I gotta put up a 5-minute chart. Okay. Well, that's interesting. The high of the day is, in fact, the open of the day. This is the beginning of the day session, and it opened exactly on its high. And this is exactly what I was saying, that when that happens, usually the market has to get back above that high. So right now, I think it's more likely than not that we have not seen the high of the day. That more likely than not that we're going to get above the high of bar 1 at some point today, usually early in the day. I think it's important that the open of the day is exactly at the high of the day. I think that's important, right? That's an important magnet, and usually it gets hit. I think we're always in short, and I think if we do get above 1, that there'll be sellers up there, and I think there are sellers here, sellers above 3. We have 2 bull bars, consecutive bull bars, but probably not enough to erase the bearishness of the 3 bear bars. Bears want a lower high major trend reversal. Right now, I think you can call this a higher high major trend reversal. We went sideways for about 20 bars. But usually when the break to the higher high is in a tight channel like this, you need at least some kind of a double top. The bears are trying to get that now. If you want, you can call it a double top, higher high. We have a high here, we have a higher high, a little double top, so a second entry short for the failed breakout above yesterday's high. That is slightly higher probability for the bears. But my one big reservation is that the open of the day is at the high of the day, and that only happens about once a year, that it stays that way for the rest of the day. This is a sell setup, failed breakout above yesterday's high, and now a second entry short. But lower probability because of that. Makes me think we have to go sideways more, because I'm sure a lot of the computers are aware of what I'm saying, and they know there's a magnet at the high of the day. For the second entry sell, the bears want a sell signal bar closing on its low. And right now, 6 is not closing on its low, and we still have the magnet at the high of 1. So to me, a confusing picture. The odds are we're going above the 1 high at some point today, probably in the first hour or so. But for the bears, they have a higher high major trend reversal below 1. The channel up is tight, so they need a second entry short. They have it here below 6, but a 2-tick tail and only a 2-tick bear body. A lot of traders are not going to take that sell. Bulls are hoping that this is an opening reversal and low of the day, but and they have 2 bull bars, but not all that big. So to me, it's a confusing picture. Probably we'll try to get a double bottom around the 3 low. Probably we'll try to get a double top around the 1 high, which is similar to what I said yesterday, that we probably get both the double top and a double bottom, and then decide which would win. And yesterday the double bottom won. Not a lot of traders selling below 6, so probably buyers at the 6 low, buyers at the 3 low, and sellers at the 1 high. So if traders are looking to buy low and they're looking to sell high, then we're probably in a trading range. Remember, there were bears who sold with a limit order at the 3 high, and some sold more 1 point higher. They need 7 to dip 1 tick below that 3 high, and it has not. And that means that the bears who sold the 3 high and 1 point higher right now are worried. They're thinking that, oh my gosh, I sold, it hit my limit order when the 7 low hit the 3 high, but it needed to fall below that 3 high for me to buy back my shorts, break even on the first entry with a profit on the second. These are scalpers, right? These are traders looking for a 1 point scalp, and they will not wait long to get out. And you can see we're right between their 2 entries. They sell the 3 high, they sell more 1 point higher. This is their average entry price. And right now they're deciding, do I just get out, break even, or do I continue to hold for a little bit, hoping that 7 dips below the 3 high so I can get out, break even on my first sell, and with a 1 point profit on my second sell. So this is an important bar. It's an information bar. Will the bear scalpers give up? If they do, we'll start to go up above the high of the day. Bear swing traders, a lot of them wanted a better sell signal bar than 6, so a lot of the bear swing traders have not yet sold. Bull scalpers, I think it's not, I don't think they've really had a very good buy scalp setup. You know, buying below 6 after the 2 bull bars, I don't think the math is good enough. So why are we going up? Well, we're going up because you got bull swing traders hoping that this is a pullback to support yesterday's close, the moving average, and that we reverse up into a bull trend. They know the probability is that will not happen, but the reward is big relative to the risk, so the risk-reward ratio more than offsets the low probability. Prominent tails again, so it's still confusing. You can see as soon as 7 closed with the bear body, you can see what happened. A lot of traders said, consecutive bear bars, I'm going to sell the market. And you can see the 8 close was at the 8 open and high were at the 7 close. All right, so the bear limit order scalpers made money, so that's good for the bears. The bear swing traders, some will take that short, others will wait for a better sell signal bar. Limit order bulls, right? Buying the moving average, buying the 3 low, buying the 81 low. It's like a spike pullback channel. So they're betting on a continued trading range. Important information here. Will we bounce 5 ticks above the 3 low, allowing the limit order bulls who bought the 3 low to make money, or are they going to get trapped? And will we work lower, down near the 78 low? You can see some hesitation. That means there are bulls buying here and bears buying back their shorts. Markets deciding, have we started to swing down, or are we building a bottom of a trading range? The bears have their double top, bulls trying to get their double bottom. They need a bull bar, and they're not going to get it on bar 8, but they might get it on bar 9. At a minimum, the bulls are trying to get a close above the 3 low. You can see we're right at the 3 low, the breakout point, and the bears want the close below. So that's important. It closed 1 tick above the 3 low, and that's good for the bulls. Remember I said that after the 3 bear bars, we probably would get sellers above and get at least a small second leg down. That's what we've had. So the minimum objective has been met. Now the bulls are trying to get an opening reversal up. I said the first opening reversal up would probably not be successful after 3 bear bars. This one has a better chance. Gap up, early rally and a double bottom, opening reversal up, gap up, double bottom, reversed up despite a lot of big bear bars, gap up, if you want to call it a double bottom or a wedge bottom, gap up, a small double bottom, 2 big bear bars, yet low of the day, gap up, double bottom, like today, 2 strong legs down, reversal up, enough selling so that a bull trend was unlikely, but we were still able to get above the high of the day. So this is a little bit similar to today. 2 legs down, 2 legs down, but the bulls need either a decent bull bar or a strong reversal up for traders to believe that we're going to test the high. Let's say it has a 3-tick bull body and closes on or near its high. Is anybody going to sell above? Well, the bears can argue that we're in a channel getting lower highs, lower lows, and they could sell above, but if it closes on the high, I would not. And for the bulls, we have 6 bear bars in the first 8 bars, and that'll make a lot of the bulls hesitant to buy, but it's a credible low of the day. Higher probability, instead of buying on a stop, you wait for the reversal up. A little doji bar, yet it led to, it was the low of the day. Higher probability, you wait until you get the reversal. We sold off, this bar reversed the sell-off, and then we get a high 2 bull flag. A little bit higher probability to buy above bull bars instead of above bear bars. So swing by above 9 if it has a bull body. Sometimes you get a wedge sell-off 3 legs down. It's still, I think, always in short, and therefore bears are selling, hoping that we get below 78. If it gets below 78, then we're falling below a major low, and that means that the day would end up as either a trading range day or a bear trend day. It would significantly reduce the chances that the bulls could get a bull trend day. You feel like we're waiting on every bar to find out where the close is. You know, was 8 going to close above the 3 low, right? Now, is 9 going to have a bull body? And I believe that when you feel like you're waiting for every bar to close, and there's a lack of certainty, you're waiting, hoping to get more information, more clarity. And that means that whatever's going on is probably going to end up as part of a trading range. So right now we're selling off, but it's behaving more like a leg and a trading range than the start of a bear trend. Not a very good looking buy signal bar, right? So a lot of the bulls will wait for a bull bar and buy above a bull bar, or they'll wait until they see a strong reversal up and then buy. A low on short is a pullback in a bear trend, the inside bar, but not a lot of bears willing to sell with a stop below 9. 8 and 9 both closed above the low of 3, and bulls hoping for some kind of a wedge bottom. You can see a bad sell signal bar and good closes on 8 and 9 above the 3 low. So some bulls bought the 9 low, looking at least for a scalp. Again, the bulls are hoping for a double bottom. It's a wedge on a smaller time frame. We went up, and we're trying to go up a third time. For a lot of bulls to buy above 9, they would like to see at least a 2-tick bull body closing on its high. Even then, it's not high probability, right? Maybe 40 or 50% chance it's the low of the day. Higher probability, you wait for a big bull bar, or you wait for a trading range, and then a second entry buy down here. The bears, I think they have a problem. 8 and 9 both failed to close below 3. So many of the days lately have had these sell-offs, and there's been something wrong with them. sell off doji bars, and then once you get the reversal or consecutive bull bars, you're probably always in long, and the day will end up as a reversal day. Unlikely to go far above the open. Here we went far above the open. That's not likely today. Bulls not getting what they want, the bears not getting what they want. Slightly more bearish than bullish, but not all that bearish. Bulls trying to get a double bottom, 79, but they're unable to get bull bars, so a lot of traders are waiting to buy. Five bars down, so not a high probability buy. A lot of bulls will wait. Getting near the close of the first hour, 60-minute chart, a lot of bars in a tight channel, so unsustainable. Probably will start to go sideways soon. I'm going to move the all-time high up to here. Tight bull channel, unlikely to become a bear trend, but it could pull back for a few bars. So tight bull channel, unlikely to become a bear trend, but it can pull back for a few bars and start a trading range. This is the final bar of the first hour. Bulls need a decent buy signal bar, otherwise they'll wait to buy a strong bull bar, a strong reversal up. And because the bears are not getting consecutive big bear bars, bears see this as a weak sell-off and probably a bear leg in a trading range, and that makes them hesitant to sell too low. They want to sell rallies up near the 6 high. Now we've had a lot of reversals like here, where the sell-off was strong and sell the close bears got trapped. Traders get trapped selling at the low. Sell-off, the bears get trapped selling at the low. And that's the concern when you start to get a sell-off and you're starting to get bars with prominent tails and you start to get 3 pushes down, or 3 reversals up. There's a significant risk selling at the low. So you sell below the low of that bear bar and you find yourself selling at the low of the day, and it's hard to reverse. So you get out on the 9 or 10 close, and then you may not emotionally be ready to buy again until it's way up here. Therefore, when I see a sell-off like this, I usually do not sell with a stop at the low. I'd rather sell higher. Is a 1-tick bull body enough to attract a lot of buyers above 12? Because of this likely forming a higher low, a pullback from this rally, some bulls will take the buy even with a 1-tick bull body like that. Hoping that we get the reversal up. Others will wait for that and then start looking to buy. Not high enough probability for a scalp. So if you're buying above 12, I would only do it if it has a bull body, and I would only do it for a swing. And if you're doing it for a swing, higher probability to wait until we get a strong reversal up. So yes, it's an okay buy with a bull body. If it does not have a bull body, I would not buy. Okay, so it has the absolute minimum, right, a one tick bull body. Can you sell the 12 high? I would not. We have a wedge bull flag, so rally, and then a wedge bull flag with a bull body. The bulls need good buying on 13 or 14. Remember, the 60-minute bar just closed, and look at it. Okay, a climactic move around a measured move up, and closing on its low. Reversal down, second reversal down, third reversal down, so a small parabolic wedge, and therefore there's a magnet one tick below the low of this bar. So right now when you look at this, the odds are we're going to trade below the low of that bar, which is the 12 low. So right now on the 60-minute chart, it's likely that we're going at least a little lower. There's the measured move above. It's above where we are. Where do the bears sell? You know, I said a lot of the bears want to sell higher. Will they sell on the stop below 12? Arguing failed wedge bottom, and also arguing it's selling below bear bar on the 60-minute chart. When a sell-off looks like this, I don't want to be selling at the bottom. I don't want to be selling below 9. I don't want to be selling below 3. I don't want to be selling below 11. And I don't want to be selling below 12. In general, if you get a bear breakout below a wedge, 50-50 chance the bear breakout will fail and the market will reverse up again. 50-50 chance the market will sell off for a measured move down. Now the height of the wedge, you can argue, is here. So maybe that would be the measured move down. Maybe that would be the measured move down. Remember, bulls bought this as a wedge bull flag, wedge opening reversal at the moving average, at the breakout point highs, 50% pullback. But a lot of bear bars, you know, only one bull bar in the past 8 bars, and it only has a one tick bull body. So a lot of traders want to see a strong 13 before thinking about buying. Bears, hoping the bear channel continues. We get a bull reversal, it fails. Bull reversal, they want it to fail, and they want it to channel down below the 78 low. I think the probability right now is about 50-50 that we're going to get a successful reversal, 50-50 that this is going to fail. I'm going to turn the screen off for a couple of minutes and restart TradeStation after deleting the cache, because I just worry that with the corrupted cache, the program might be more unstable. Okay, I'm starting it up again. It's interesting to me that on the 5-minute chart, there's a significant reason for the market to get to a new high. That is that the open of the day is at the high of the day, and that is unusual. It usually does not last. And then on the 60-minute chart, we have a third reversal down. So strong breakout and then reversal, reversal, reversal. And we have a decent bear bar closing on its low. So to me, the 60-minute chart looks like we're going to trade below the low of the first hour, which is the 12 low. So right now, there's a reason to go below 12 and a reason to go above 1. Bulls need a strong reversal up. 13 is okay, but not a lot of panic bears desperate to get out of shorts, quickly buying back those shorts, and not a lot of eager bulls believing that this is the low of the day. So it still has a confused look. Bear channel, but 3 bull bars closing on their highs. So a lot of bears will not sell below 14 or 15. And the bulls now have had 10 minutes to make 1 point from a reasonable buy setup, and they have been unable to make their 1 point. So not behaving like a trend day, it's behaving like a trading range day. Target for the bulls is the 6 high, and target for the bears is 1 tick below 12, because then they want to get down to 78. I am still neutral. I do not think it's always in long yet. I think the bulls need at least 1 more bull bar, because these 3 bull bars are small. So it's still slightly more likely that we're going below 12. Everybody wants clarity, but we're not getting it. The limit order bulls who bought the 3 low were unable to buy more 1 point lower. 12 needed to get 1 tick lower. The bulls who bought the 9 low were able to make 1 point. And the bears who sold the 10 high made 1 point. But nobody's making a lot of money. Nobody can look at it and say it's clearly going up or it's clearly going down. A lot of times when you have a trading range day, the first leg only lasts an hour instead of 2 or 3. And that's what the bulls are hoping, that the first leg down is a 1 hour wedge bull flag and that we begin a 2 to 3 hour swing up. Tight trading range now for about 8 bars. For the bears, they have a double top, and for the bulls, they have a wedge bottom. And probability about 50-50 for each. There's a good reason to get below 12. There's a good reason to get above 1. But, if we do get above 1, it's possible that we may not get there until late in the day. Trade station locked up again. I just deleted both the cash and the tick cash to see if that will solve the problem. Bulls want a double bottom with a wedge bottom. They want the bear breakout to fail, and the bears are hoping for a measured move down. What's more likely? The odds are, in general, it's 50-50. I think it's slightly better than 50-50 that the bear breakout will fail because of how strong this is. This is a higher probability buy than above 12 because it's the second entry buy for the wedge. It's still a wedge, different ways to draw it. Now you can say 1, 2, 3. Remember I said that the 60-minute chart looked like we probably had to trade below the low of that 60-minute bar. And bulls are hoping that the bear channel has ended. We have a wedge bear channel, and the bulls want a bull breakout and a swing up. The bears want the bear channel to continue. Now, I said higher probability of a reversal up above 18. Does that mean there's a higher probability of a measuring gap if we fall below 18? It probably does mean that. All right, the bulls have a better bottom here. This is the first, I think, decent buy all day. So if they fail to rally here and begin to swing up, I think the odds increase that we're going to have a swing down. The bar 18 range, right? So right now, theoretically, 90% chance we've seen either the high or low of the day. The bulls are hoping that 18 remains the low of the day. It's fairly common around bar 18 to get, and let's say bar 18 is near the low of the day. It's fairly common for the market to reverse up above 18 or for the market to get a one-tick breakout around bar 18 here, exactly bar 18, and then reverse up. So what goes on here is important. It sets the tone, I think, for the rest of the day. You know, is this going to remain a trading range day, or are the bears going to have a bear channel all day? It's still too early to know. Market's giving the stop entry bulls a lot of time to buy at the same price that the original stop entry bulls bought. Remember, you had bulls who bought one tick above 18, and the bulls who did not buy with a stop have had a lot of opportunity to buy at that same price with a limit order, and bulls do not want to see that. You know, if you're a stop entry bull buying above 18, you want it to go straight up, and you want it very difficult for any other bull to buy at your price. If it becomes easy to buy at your price, you know, maybe your price is too high. Right now, 50-50 chance that this is the low of the day, 50-50 chance that we're going to get down to the 78 low. Maybe slightly better for the bulls. Small. You know, the stop order bears who sold below 11 did not make money. The stop order bears who sold below 15, 5-tick trap. The stop order bulls who bought above 10 or 12 did not make money. So that's just a reflection of how small everything is, and it increases the chances that today's going to remain a pretty quiet day. Stop entry bears selling below 9, selling below 11, selling below 14, all failed to make even 1 point. And they have another sell now below 20 and below 18. But since it's so hard to make money selling with a stop, a lot of bears will wait to see if we get a big bear breakout and then sell. Suppose we get a perfect double bottom with 18 with a decent bull bar. That would be, I think, a pretty good buy. Right now we're on a reasonable buy, but the reward is probably not all that big because the day is probably going to be a small day. I think the bears get out. You know, they could get out above 12 as well, but they got to sell again below a decent bear bar, either below 15 or 17, but I would not sell below 17 because we're right near the bottom of the 18 bar range and too much risk of a reversal up when the sell-off is weak. So let's say the bears get out above 18. Do they sell again below 20? I don't think so because of only a one-tick bear body. Do they sell below 18? Well, you know, I would rather sell below a decent bear bar. So I think the bears who get out above 18 are kind of stuck. They'll need maybe a low 2 short and then sell below the low 2, or they need to sell a big bear close if we get a big bear bar breaking far below the 18 low. You know, when Guy Adami says the market never gives you a lot of time to sell a top, you know, I say that's wrong. However, whenever the market gives you a lot of time to do something in general, there's something wrong. And the bulls are getting a lot of time to buy at the 18 high, and that increases the chances that we're going at least a little bit lower. The computers do not know. Nobody knows, right? So it's still a 50-50 market. Is this the low of the day? Or are we going to break below 18 and get a measured move down, and then 1 remains the high of the day? Everybody wants clarity. Everybody wants more information. Will bulls buy the 18 low? I don't think so. I would not. So, I said better than a 50-50 chance there would be buyers at the 12 low. I think less than a 50-50 chance there'll be buyers at the 18 low. This is the second entry buy, both with decent buy signal bars. So, if the bulls try something twice and fail, usually they wait for a couple legs down before trying again. This is one of those setups where the math is interesting because the bulls buying right here are risking to 1 tick below 18. So right now they're risking maybe 3 or 4 ticks depending on where they get in. And the reward is 3 or 4 points. And probability is, probably about 50-50. So the math is actually pretty interesting right here for the bulls. And the bears, if they're selling here, stop probably above 15, and they're looking for a measured move down. So I think the probability is about 50-50, but the risk-reward ratio is slightly better for the bulls. It'd be better for the bulls if they can get a double bottom or get another bull bar closing on its high. But unless we break strongly above the moving average, the bears still have a chance at a low 2 short. So low 1 below 20, and let's say a weak reversal up on 22, and then maybe a low 2 below 23. This is the first time all day when the bears might sell at a new low. The bears did not sell here, did not sell here, did not sell here, did not sell here, did not sell here. But this is the first time that they might sell because the bulls will probably give up. The day is not likely to become a big trend day. We're an hour and a half into the day and we still have no clarity. So if it's going to become a big trend day, then one side is strong, and usually it shows that strength before 2 hours. Small double bottom 18, but 3 consecutive bear bars. Not a good buy. Again, if the bulls get a perfect double bottom with 18 and they get a bull bar for the buy signal bar, that would be a reasonable buy. And I think a really difficult short on a stop below 18 because stop order bears have been losing money all day, even though we're in a bear channel. For the bears, it's a low 2 short 20, but a pretty good bull bar, so not a lot of traders willing to take the short, especially when today's probably a trading range day. And if it's a trading range day, you get a bear leg and then a bull leg. And bear leg might be an hour or 2 or 3, and we've gone down far enough for a credible bear leg to be over. So it's a low probability short. So it's a low 2 short with 20. It's a double top bear flag. We have a bear trend, double top bear flag, or a double top lower high with 15. but I think we're always in long, and I think there probably are more buyers below 24 than sellers. The bears really need to get below 18. Remember, 18 bar range, once you've seen the close of bar 18, there's a 90% chance you've seen either the high or low of the day. So if we get below 18, then 90% chance one is the high of the day. If we start to rally here, then 90% chance 18 will remain the low of the day. Right now, there's a 90% chance one of those two is the extreme of the day. And it's really fascinating. I mean, obviously it's boring, but it's fascinating as well. Stop entry traders are not making money. Over the past 15 bars, nobody's making money with stop entries. And everybody knows if the market falls below 18, the day has changed. And therefore, it's a reasonable swing sell. But, we're in a 15 bar tight range. And in general, selling with a stop at the bottom or buying with a stop at the top is a bad strategy. The bulls that bought above 18, a lot of them gave up. They have two legs up to a lower high and a 5-tick trap. So a lot of the bulls are selling out. And then other bulls might buy at the 18 low and just above, trying to prevent the bear breakout. But I think a lot of the bulls, if it falls below 18, I think we'll probably get a couple legs down, because I think a lot of the bulls will give up. They say they had a wedge at 10, another one at 12 with a decent buy signal bar, and then another one at 18, and it's not working. And maybe we're going to go down and chest the magnet at the 78 low, which to me, if we get below 18, I think that is likely. However, the bears who sell below 18, their stop is up here, so their initial risk is about 10 ticks, and that is a lot on a day where the range is so tight. We've been in a 8-tick range now for 15 bars. The alternative to selling on a stop below 18 is you wait for the breakout. If it's big, you sell the close, or you wait for the breakout and then wait for a pullback and sell the pullback. Bulls trying, you can see they're trying to prevent it from falling below that 18 low. A lot of the bulls, theoretically the swing bulls, still have their stop 1 tick below 18, and they're buying more at the 18 low and 1 tick above, trying to prevent it from falling below 18. But the day will have changed if it gets 1 tick below 18. Will bulls buy below 18? I would not. I would wait. I think a lot of bulls will give up. They've been trying to bottom for over an hour, and they keep failing. It keeps going up, up and up and up, and it keeps failing. So I think that makes it likely, if we fall below 18, which we just did, it makes it likely that we'll fall for a couple legs. Some bears sold 1 tick below 25, and they're able to scalp out here. Other bears sold 1 tick below 18, and they have a 5-tick trap. And it looks like it's a give up bar. It looks like the bulls finally gave up, and therefore the odds are there'll be sellers above 27, no matter what it looks like, and that will get at least a small second leg sideways to down. Another bigger wedge, now with 3 and 12, but big enough bear breakout, plus stop entry bears made money that probably sellers above. Let's say 28 has a 3-tick bull body closing on its high, then I think a lot of the bears will not sell above. And for the bulls to buy it as a failed breakout, I would not do that. I would want a second entry buy. The odds are we're going to get a small second leg sideways to down, possibly down to the 78 low. The bears want to get below 78 because that's the last line of defense for the bulls. It's 78 low is a major higher low, we have a strong breakout to a new high. And some bulls are hoping that whatever channel we get remains a bear leg in either a trading range or a bull trend, a deep pullback. The bulls are hoping this is a bull flag, but big enough breakout, probably sellers above. Will bears sell the 27 high? Not if it looks like this. They'll wait to sell higher. And for the bulls, I would not buy it. I would wait for a second entry buy or for a strong reversal up. You have limit order bulls who bought the 18 low and 1 point lower. Others simply bought 1 point lower, betting that the breakout would not get far. And both needed to get one tick above the 18 low. So we'll get information here. If it gets above the 18 low, then this is probably a bear leg in a trading range. If it does not, then it's probably a measuring gap, and we may get all the way down here. I think not likely. Maybe a measured move down from one of these highs like that one, or here we have a double top. A lot of the bears who took profits want to sell again, and so they take profits 1 point scalp. They want to sell again, but they don't want to be selling above a good sized bull bar at the bottom of a weak channel. Theoretically, you can sell the close and get out one tick above 27, so you're risking a couple ticks, hoping to make another 1 point scalp. But I don't like to see, if I'm looking to sell, I don't want to see a good looking bull bar right after the bear breakout. Remember, I said this could be a bear leg in a trading range, and we have a bottom attempt for a first leg down. Sometimes you get a second leg that traps traders into selling low, and it's a second leg trap. So this is a potential second leg trap. I'm going to turn off the screen for a minute and open up my example folder. Now, let me try that again. Like this. Strong breakout, strong breakout. Attempt at a wedge bull flag, attempt at a wedge bull flag. Bear breakout and then a bull bar. Bear breakout and a bull bar. And it was a second leg trap. So this is why I don't want to sell at the 27 high. 26 just looks 27 looks too good. It looks similar to this. To get it long again, the bulls need this. They need 2 or 3 bull bars with at least one of them being a pretty good bull bar. And look what happened. 2 legs up, and it failed. It became a second leg trap for the bulls. And that's the nature of trading range days. You often get second leg traps. We have a channel, first leg up, and then a very strong second leg up, and it was a trap. And then 2 legs down. You can call this the first leg down, and then a triangle or a trading range, and then a second leg down. Or you can call the attempt at a wedge as the first leg down. Bears, if they're still short, I would get out above 27. because you do not want to see a good looking bull bar after a bear breakout like that. What's different between this and this example, this tail? All right, breakout, you often get a second leg down. So 1, pullback 2. Here we've only had 1 leg down. So this is slightly more bullish than this is. We still might get a small second leg down. However, not a lot of bears are going to sell the 27 high. Not a lot of bears are going to sell the 28 low. Bulls, the scale-in bulls, they still need one more tick. They need to get above the 18 low. Whether or not they do, probably bulls will buy the 28 low or the 27 low, and the 78 low for that matter. Bears trying to get a gap, a measured move down. Important price, right? Limit order bulls who bought the bear breakout made money, and that makes this much less bearish, and it increases the chances that it's a second leg trap in what will become a trading range day. You hear me talk about trending trading range days versus, you hear me talk about small pullback trend days versus bear legs and trading ranges. And the bears are hoping that today is a small pullback bear trend. We have a gap 6 low and 14 high, but no gap here. 24 high went above 14 low. The pullback here went above the 18 low, but only by 1 tick. So it still could be a small pullback bear trend day. However, here we are 29 bars into the day, and we do not yet have a convincing gap. Sometimes you get a 1 tick overlap, a negative gap like that by 1 tick, and it still becomes a small pullback bear trend. But I think the odds are against it. We're getting too many reversals and too much overlap. So I think this is a bear leg and a trading range. The day is simply deciding whether this is the low of the day, or maybe we get a little bit more down, maybe even below 78 for the low of the day. Probably buyers below 29 and buyers below 27. Remember, the always in bears, they get out here above 27 and they have to sell again if the bears create a decent bear bar. And the bulls see that limit order bulls made money buying below 18 and 1 point lower. And now we have 3 consecutive bull bars. 28, 29, not very big, but still 3 consecutive bull bars. The bulls see they made money buying at a new low. Now they may try to buy a bear flag instead of waiting to buy all the way below 29 and 27. They may start to buy the 29 low. It's a low one short, so it's a bear flag. So some bulls will start to buy the bear flag instead of waiting to buy the new low. Bears hoping still that this is going to lead to a measured move down. We have a negative gap, and it's only a 1 tick negative gap. We only overlap by 1 tick. If you overlap by 2 or 3 ticks, it reduces the chances that you're going down and increases the chances that you're going up. Remember I said that 25, 26 strong enough for a second leg down. Sometimes the second leg down does not go below the low of the first leg down. So we can get a higher low, and that could be the end of the second leg down. That's fairly common. Yesterday, Friday, you can say strong enough for a second leg down, and this might be the second leg down, or that might be the second leg down. And then the bears gave up over here. So it's fairly common for a second leg not to make a new extreme. And that's true up and down. And sometimes the second leg is small, strong enough for a second leg up. Sometimes the second leg is just one tick, strong enough for a second leg down, only one tick. I got a bigger second leg down later. Strong enough up for a second leg up. This might be it. Well, this might be it. And it came in as a lower high. The bears want a bear body on this to increase the chances that the low one short will work. And instead we have a fourth consecutive bull body. And you can see the 30 low is exactly at the 29 low. Why do you think that is? It's the bulls seeing that limit order bulls made money below, and now they have 3 bull bars, and a lot of the limit order bulls placed a limit order to buy at the 29 low, and it hit their limit order on bar 30, but most of them did not get filled. So the bulls are eager, and that increases the chances that we're going to bounce from here. Now, right now, there's a 90% chance one will remain the high of the day. By the close of bar 18, there's a 90% chance that you've seen either the high or low. Since we went below 18, then 18 is not the low. That means that this is probably going to remain the high for the rest of the day. And because of that, bears will sell rallies, but because of the second leg trap and limit order bulls making money, the bears might wait to get up to a prior lower high, like the 24 high, maybe even the 6 high, before they sell. Trading range days usually have legs that last 2 to 3 hours. First leg down lasted 2 hours. If it has ended, we don't know that yet, it looks like it has, but if it has ended, then the bulls will look for sideways to up for 2 to 3 hours. Remember that one tick gap still keeps open the possibility that this is a small pullback bear trend day. If we go 2 ticks above that 18 low, then I think it becomes unlikely that this is a small pullback bear trend day. Small pullback bear trend day tends to get gaps all day long. Here we had a gap and then another gap, but it closed and closed by 1 tick here. Let me just get a zoom in on that. Yeah, it closed by 1 tick there, and then it closed again over here, and that meant that a small pullback bear trend was unlikely, and it made a trading range likely. Gaps. That is what a small pullback bear trend day usually has, lots of gaps. And we do not have that today. We have one negative gap, but the bears need more. Limit order bulls probably buying the 29.30 low, hoping that this is the end of a swing down in a trading range day. The bears are selling, but with 4 consecutive bull bars, not a lot of bears are going to take the sell, especially after limit order bulls made money. What happens if we fall below 78? I think a lot of trading range trading and probably buyers below 78 if we get there. That's where the bears are trying to go. They're trying to get below that 78 low. Now, if you're a bull who bought the 30 low, where's your stop? Well, you probably have to risk at least a couple points below 78. The market's deciding, is this the second leg down, bar 31, or are we going to get below the 78 low? And it's deciding, is this a bear leg and what will end up as a trading range day, or is it a bear leg that is early in a small pullback bear trend day. It's more likely that it's a bear leg in a trading range day, and it's searching for the end of the bear leg, and it might be here, it might be below 78. I missed a trade in the euro. The range was so small. I don't have the scale right here, but the range was so small. I ended up deciding not to buy the pullback, and the bulls who did got the scalp up. It's still probably always in short, but I think probably buyers here, unless the bulls get a strong break above the moving average. The odds slightly favor the bears, but I think the odds are against the market ending up as a small pullback bear trend day. I think more likely this is a bear leg and a trading range day in search of the low of the day. Bulls hoping for a higher low, but 3 consecutive bear bars. Looks like we might go sideways here more. Let's say we go sideways for 5 or 6 bars, we get a double top bear flag, and we get a breakout to the downside. Probably buyers below. This looks like a bear leg in a trading range day. It often tries to bottom around bar 24, either here or here. And if it fails to bottom at 2 hours, it then often tries to bottom at 3 hours, which is around bar 36. And it looks like that's what the market is deciding right now. And the bears are hoping for a small pullback bear trend. We're in a bear channel for 3 hours, almost 3 hours, but decent bull bar 12, decent bull bar 18, decent buy setup 12 and 18, and then again 27. All of that reduces the chances of this being a relentless bear trend, and it increases the chances that it's a bear leg in what will become a trading range day. That is more likely that there'll be buyers around where we are, and that will go sideways to up for 2 or 3 hours. What do the always in bears do if they're trading always in? I think they get out above 27, and theoretically they would short again below 32. With the 4 consecutive bull bars, I think a lot of them will wait to see if we get a double top with 31 and then sell. Little triangle, 3 reversals up, 27, 32, 34, but not high probability. The bears are hoping to get a low too short, maybe a double top with 31, and the bulls need to reverse this. They need 1 or 2 big bull bars to reverse that, which they do not yet have. Until then, the odds still slightly favor the bears, so it's still slightly always in short. The bears want a small pullback, bear trend, lots of gaps. More likely, it'll be a second leg trap in a trading range day. So more likely, we'll soon get a reversal up to reverse that final sell-off. Sell-off, sell climax. Bulls need a reversal up. If they get it, even if it's 1 bar, if it is big enough, let's say it closes 3 or 4 ticks above the moving average, that would be enough to flip this back to always in long. Remember, bears want the double top, 31 at the moving average. And so far, 35 is not enough. The bulls need a strong breakout above the moving average. Otherwise, the bears get a bear bar on 36 and then a double top bear flag at the moving average. So this is one of those important bars. It decides whether we're going down below 78 or rallying or going sideways to up for the next 2 or 3 hours. Let's say it's a 1 tick bear body. Will the bears sell? I would not. I think the bears need a strong sell signal bar for the bears to sell again. We're still always in short, but it would just take one good bull bar to flip it to long. They need to reverse these two bars, and if they got one big bull bar closing somewhere up here near its high, then the odds are we're going to go up for a couple legs. It's a one tick bear body. The bulls might stay long, stop below 34. A lot of the bears will not take the short if it's only a one tick bear inside bar. This is the close of the third hour. Not a good sell signal bar. I mean, it's a good bar, but not good context. Tight channel, so the reversal is probably minor. Not a good entry bar for the bears. They're trying to get good follow through, but so far a big tail on the bottom of the bar. So bad entry bar and bad follow through. So not bearish. Remember I said that I thought this is the best the bears would probably get, sideways for, 5 or 10 bars. All right, so still continued confusion. Do the bulls get out below 36? I think if you bought above 34, you're probably swing trading, and I think your stop is still probably below 34, just in case we get a double bottom. Sometimes you get a reversal, and the context is not all that great, and you need to get a double bottom before the reversal takes place. And that example that I think is similar to what we have here. We got a wedge. We have a strong breakout and a wedge bottom. Strong breakout and a wedge bottom. It broke below the wedge bottom. It broke below the wedge bottom. It reversed up, but the reversal stalled, and it became a bull leg in a trading range, and the day remained a trading range. And I still think that's the case here. So even if the bulls get their breakout, we're probably going to remain in a trading range day. We've had a lot of reversal days where the market sells off for 2 to 3 hours and then rallies for 2 to 3 hours. And the bulls are trying to get that reversal. Sometimes you'll get a reversal up to a new high of the day. But if the sell-off lasts a lot of bars and falls fairly far below the open, usually if you get a reversal, it does not go above the high of the day. But it still can trade up for a few hours, like this, and traded up for several hours, but did not break strongly above the high. In trading ranges on the daily chart, you see a lot of reversal days. So we sold off, we rallied for several hours, but did not get above the high. And on the daily chart, this becomes a reversal day. It has a big tail on the bottom. And if you look at the daily chart and a bull trend, you'll see that a lot of the days have big tails on the bottom. And those are all reversal days. The market sells off at rallies, sells off, rallies, sells off, rallies, but does not keep going up. It just ends up closing around the open. Big sell-off, rally, right? Sell-off, rally. Here rally and sell-off, rally, sell-off, rally. So a lot of the bars with the biggest tails close around the open and do not become big trend days. Even if they trend for 3 or 4 hours, usually they end up as a doji day like this. So sell off, rally, sell off, rally, sell off, rally, but does not go on to become a big bull trend day. It does not close far above the open, does not close far above the open, does not close far above the open. And right now we have a bear day, but if we rally for the next 3 hours, we'll get back to the open, and today will end up looking like that. Instead of a big trend day, it'll be a doji day. Opening near its open, selling off, and then closing back near the open. Can it still be a small pullback bear trend day? Well, I think it's not likely. I think it's more likely we're going to get a sideways up leg testing the most recent major lower high, which is 24. So are we always in long yet? It's hard to say that we're always in long until we break strongly above the moving average. And whenever a day does not clearly become always in short until right before it reverses and becomes always in long right before it reverses down, that's one of the signs of a trading range day. We have a triangle. 3 pushes up, 1, 2, 3. tight trading range that has 3 pushes one way or the other, especially if it has either higher lows or lower highs. It's a triangle. Does not matter if you call it a triangle or a tight trading range. The meaning is the same. It's breakout mode, 50% chance the breakout's up, 50% chance it's down, 50% chance the first breakout reverses. Context, I think, slightly better for the bulls. We've sold off for 3 hours and we've stopped selling off, and the sell-off is not strong, and it's probably not a small pullback bear trend day, and therefore it's probably a bull flag. So bull breakout, bull flag, and probably we'll get the bull breakout and test up somewhere around here. I think it's pretty interesting, right? It's terribly boring, but what is the bear case? Are we going to break strongly below the triangle, and how far down will we get? If we do break below the triangle will probably be the final bear flag, and we'll probably get a reversal. I think the downside, therefore, is limited. On the other hand, what happens if we break to the upside? Well, look how quiet the day has been, and therefore if we get the upside breakout, the upside limit is probably to between this high and that high. So the upside is probably just a point or two above where we are. The day probably is going to remain a small day. Are we always in long yet? I think we probably are always in long, simply because the bears continue to fail. The bulls now are trying to get their breakout. They're trying to reverse 25-26. So they're trying to get 1 or 2 big bull bars, and then everyone will agree that the bulls have taken control. That does not mean that it'll be a bull trend. It just means that we're probably trying to go sideways to up for for an hour or two, and we've already gone sideways for an hour. Okay, I said that it was important if the bulls could get 2 ticks above 18. Well, they just did. The bears are hoping it's a 1 tick failed breakout above the triangle and that we have another leg down. But I think there'll be buyers below the low of the day and buyers below the 78 low. So I would either be long or flat. And for me, I don't see how I can sell down here. And I would not be selling on a stop below these lows, because I think if we get the bear breakout, it will only last a bar or two, and it's more likely there are buyers below these lows than sellers. The odds are against a continued bear trend. Small pullback bear trend days cover more ground. They don't stay in a 2-point range for 30 bars like this, 2 or 3 point range, and they don't get 2-tick pullbacks. So I think the odds are we're probably always in long, and we're probably going to work up to these lower highs. But we're probably not going to go up very fast, just like we did not go down very fast. 15-minute chart, you can see it's a bull II. It's IOII, 4-bar very tight range, an hour of very tight trading, breakout mode. The limit order bulls from the 30 low need 1 more tick for a 1-point scalp. I bought that low, and I'm just sitting here, just waiting, trying to get out with 1 point. If this reverses, I'll get out, probably break even. Keeps hitting the limit order, and if I get lucky, I'll get filled, without it going above the limit order. I could hold for a test of the highs, but it's such a quiet day that I'm just trying to get out with 1 point. So what does that tell you? It tells you that a lot of the bulls that bought the 30 close only wanted 1 point. It had to go up 5 ticks from that close to make their 1 point, and it did. For the bears, they're hoping that the bull breakout fails and that we continue to channel down with lower highs and lows, and especially get below the 78 low. But even if it does get below the 78 low, chances are there are buyers below. Limit order market. Traders buying below stuff all day long, and they'll probably continue all day long. I think we're always in long, even if 43 is a bear bar. I think a lot of bears will not sell this low. They have to conclude that we're going to work up to the 24 high, and therefore it's not a great short this down here, even if it's another bear bar. So yes, the bulls sold out, so the bulls are flat, or they might be swinging to try to get up to the 24 high, but unless 43 closes on its low, I think a lot of the bears are not going to sell unless we get up here. This is the sell zone, these lower highs, and I think we're always in long. But I'll change my mind if 43 closes on its low and 44 trades below. It creates a problem for me because I don't want to sell here. I think the bears had their chance to get below 78 and they kept failing. And they had a strong breakout here. And this is actually similar to bar 18 where we had a wedge bottom and then one more low. Here we have a triangle. If you want, you can call it a wedge, and then one more high. I still think we're going higher. So this is one of those interesting buys. You buy right here at the market and put a stop one tick below 43. So you're risking 2 ticks, hoping to make a couple points. Probably you lose money. Whenever you're only risking 2 ticks, you usually lose money. However, the math is actually okay. The bulls are going to try to stop it from falling below 43 because 43 is a good-looking bear bar in a bear flag. So the bulls will try to stop it from getting below 43. The bears are trying very hard to get below 43. Therefore, if it does not get below 43, that means a lot of the bears will give up and a lot of the bulls will get confident and other bulls will buy. So what do? Well, I'm back to flat and I'm waiting. I want to buy low, but it would be nice if we get a breakout below 78 and then a reversal up. Like this, a strong buy climax, breakout, and breakout below and a reversal up. When the range is very tight like this, very few opportunities to do anything. The bears, they're always in bears, they probably have to sell right here below 43, but I am flat. I think the odds are against a big bear trend day. We're more than 4 hours into the day, and we're not making much progress. Bulls trying to get a double bottom with the 34 low, but traders will not buy it unless we get a decent buy signal bar 46. And bears know that when you get a reversal, sometimes you get a double bottom, higher low, double bottom, higher low, major trend reversal, and therefore the bears want to get below the 34 low. They really want to get below the 78 low more than anything, but even if they do, there probably will be buyers below. That's the double bottom, lower high, major trend reversal. So you can look at this as a small bear trend, a bull breakout, and a double bottom, higher low. So is there a major reversal? Well, it's not a particularly strong bear trend, but it's a setup for a swing up. Not a lot of traders are doing anything here. I did not take the sell below 43, and I did not take the buy above 46. So the range right here is too tight for me. I'm going to wait for more information. I'd like the breakout to go below 78 and reverse up, and then I might buy that. Or if we start to get a series of bull bars, I might buy a close looking for a test of these highs. Bulls trying to hold the ledge here, but right now I think better than 50-50 chance we're going below the 78 low. The bulls have had an hour and a half to get up to these highs and they're failing. So if they repeatedly try something and fail, they usually then try the opposite. and there's obvious support 78 low, so we're probably going there. I don't know if we break below it, but if we do get below it, we're probably not going far below it. Will bears sell on a stop below 78? I would not. Chances are some bulls will get stopped out, other bulls will start buying. Yeah, I would not take the sell. The bear channel is too weak, and this is more likely a sell vacuum test of support than the start of a big gap and a trend down. However, I'll change my mind if we get one or two big bear bars, then I'll sell closes. This is another type of a wedge. We had a wedge here, a wedge here, a wedge here, and now 3 reversals up, 1, 2, 3. So another type of a wedge, but big enough breakout. The bulls either need a very strong buy signal bar, or they'll wait for a second entry buy. And I think there are limit order bulls buying right here below 78, trying to buy 1 point lower. You can see it fell exactly 4 ticks below, and that's because a lot of bulls either bought the 78 low and tried to buy more 1 point lower, or they did not buy the 78 low. They simply placed a limit order to buy 1 point lower, and therefore there are a lot of bulls buying here. The bears know the bulls are buying here. The bears have a 6 tick breakout below the low of the day, so they're buying back their shorts, and all of that reduces the chances that we're going down a lot further, and it also means that there are a lot of buyers exactly right here. The bear scalpers, the bears scalped. They sold, they bought back. The bulls bought, they tried to buy more, 1 point lower. Stop entry bulls, what about buying above 50 if it closes on its high? My hesitation is that when the market sells off in what appears to be a bear leg in a trading range, and it lasts 4 or more hours, the upside starts to get less. You know, I think it's okay to buy at the market, 78 low, buy more 1 point lower. Stop order buy above 50. I'm probably not going to take it. I'm probably going to wait. This is what the computers see. Reversal up, and now a third reversal up. And they see this entire sell-off as a pullback from this bull breakout, even though it pulled back below that low. Sometimes you'll get breakouts and a pullback below the low, and it's still a bull flag. Okay, 1 tick bull body, that's enough for me not to buy it. Bull breakout, pullback below the low, but I still see this as a pullback from this breakout, even though it's a new low. Bull breakout, reversal down, but I see this sell-off as a pullback from this breakout, even though it fell below that low. Gap up, fell below the low, but this reversal up tells us that this whole thing was a bull flag, and that even though this fell below that low, this was a pullback from this breakout. You know, you don't have to view it that way, but that's how I think of it. I don't think of it as a bull trend, a bear trend, and now a bull trend again. I think of it as a bull trend and a very deep pullback, and the bulls did not buy again until it got below the bottom of the bull trend. 5 ticks above 78. Some pause. The bulls who bought the 78 low need 5 ticks, and they're scalping out, so we got bulls selling here. We're in a bear channel, keep getting lower highs and lower lows, but bulls are making money buying below bars and scaling in lower, and that makes a lot of bears unwilling to sell. You know, we're around the middle of the most recent bear leg, so this is the sell zone. stop above here. But a lot of traders instead would like to buy a pullback, either below 50 or maybe around a 50% pullback, which is around the 78 low. The bulls try to get a double bottom over here, slightly higher low double bottom, and they're trying again here. This is a second entry buy, higher probability than the first entry buy above 50. For the bears, theoretically they sell below 53, but I would not. The channel is too tight, so I'd rather be looking to buy, especially with limit orders below bars than with stops above bars. However, it's reasonable to take a stop entry buy for a swing up, to the top of the most recent sell climax. 3 pushes down, 1 pullback, 2 pullback, 3. Unlikely to reverse all the way back up to the open. 90% chance we've seen the high of the day. The bear trend is weak, and that increases the chances that the bears will take some profits before the end of the day. And that means that we'll try to get some kind of a bounce. When is the last time stop entry bulls made money? You have to go all the way back to the 3 high, and no one's going to be buying that for a stop. So, the stop order bulls have not made money. They've made limit order bulls have made money, but buying with stops has been a bad strategy. We're in the buy zone, around a 50% pullback of the bull reversal. Second reversal up from below 78, so that's good for the bulls. But it's probably better to be buying with limit orders below bars than with stops above bars. Also, when a reversal takes place this late in the day, it usually does not lead to a big trend because there's not enough time left. It took 4.5 hours to get here, and we only have 2 hours left. So unlikely that we'll get all the way up here. Not a good looking buy signal bar, but for the bears, I have a hard time. It would be hard. Selling around a 50% pullback makes sense. That's what the bears did. So here's the most recent bear leg. They sold the 50% pullback, and the ones who did are scalping out. They're buying back their shorts here, but selling with a stop down here, I would not do it. Best choice right here. I don't know. If I were doing anything, I would be long right now, buying somewhere below 53. Bear bar closing on this low. I probably would buy at the 78 low, or a 50% pullback from this rally. Even though it's always in short, I think a lot of the bears would sell a 50% pullback, which is right here, and then scalp. So a lot of the bears are buying back their shorts. They don't want to sell too low, and the bulls do not want to buy too high. Endless pullback, endless bear channel. A lot of times when you get these days where the gaps close and bulls continue to make money, at some point you suddenly get a big gap, and it never closes. It stays open for the rest of the day, and the bulls get trapped. Usually not, but that's the risk right here. At some point, traders decide that we're not going to rally up and test the lower highs, and that instead we're going to continue to channel down all day. I am flat. I did not buy the 50 low, although I think it's probably okay, and I chose not to sell the 53 low. If we get a second decent bull bar like 50, I'll probably buy it for a second entry. 2 legs down, 1 pullback, 2. When we're not that far above yesterday's low and Friday's low. We could go outside down. I mentioned over the weekend that if we get a gap down at any point in the next 2 or 3 weeks, it would create an island top on the daily chart, gap up and then gap down. Usually island tops are meaningless. They're minor reversals. Here we gapped up, gap down. But because the weekly and monthly charts are so extremely overbought, more than ever in the history of the past 50 years of the S&P, there's an increased risk of a reversal down, and it will begin with some kind of a pattern. And that means that any reversal down has an increased risk of being the start of a big swing. It's still more likely to fail, but traders are aware of how overbought this is, and once it starts to sell off, it could sell off very, very quickly and very far. If I were doing anything right here, I would buy. Every new low, traders would buy and buy more lower. 60-minute chart, tight bull channel. We're starting to pull back. Sometimes you get an endless pullback, 10 bars, 20 bars, and then instead of a bull flag, you start to wonder if the market has begun a bear trend. But even if we do pull back for 10 bars or 20 bars, traders would then need a strong breakout or a gap down to make traders believe that the top is in. Remember, I said last week that when we broke above this trend line, in general, 75% chance the breakout reverses back down within 5 bars. But that's on the highest time frame that shows the pattern. And, is the 4-hour chart the highest time frame? I don't know. The channel is still really tight. And what about a 2-hour chart? I don't know. When the channel is this tight, I think that the reversal down is less likely. The channel, for traders to view it as a channel instead of just a breakout, you have to have legs up and down. And this is so tight that I don't think of it as a pattern where the breakout reverses within 5 bars and gets down to the bottom of the channel. We already broke below the bottom of the channel here. Now we're breaking above the top. The target is, again, the bottom of the channel. I don't know. I don't think that when the channel is this tight, that the probabilities are all that good betting on a big reversal down. Getting near the 60-minute moving average. I left the trend line in because that's still a target. Closing below the midpoint, a lot of bulls are not going to buy the close, and I think a lot of bulls did not buy the 50 low because we're getting too late in the day. It increases the chances that we continue to channel down all day. Remember, if there's a sell-off that looks like a bear leg in the trading range, and you're expecting a bull leg in the trading range, the bull leg usually begins by the end of the second or third hour. And now we're at the 5th hour, and that makes it less likely that we're going to get a bull leg. We have a potential final flag, a triangle. So the magnet is back here, apex of the triangle, maybe the top of the bear leg. But I am flat, and I probably will not buy above 59. Sell the close always in short, but right above the 60-minute moving average. So I am flat. I'm not selling the close, and I'm not buying the close either. I think there's an increased risk that the gap below 50 stays open, possibly for the rest of the day. It would be more likely if this breakout was bigger. We're very close to yesterday's low, and today may become an upside down day. Daily chart, you can see we traded above yesterday's high, reversed down, and we're near yesterday's low. Traders will see that as bearish, and if we gap down at any point over the next few weeks, like tomorrow, then we'll create an eye on top. If we do not gap down and simply sell off to below Thursday's high, we'll close the gap, and the gap will become an exhaustion gap. Normally, exhaustion gaps and island tops are minor reversals, but because the weekly and monthly charts are historically overbought, they've never been this overbought in 50 years, there's an increased chance that the reversals will be major and not minor. You can see it's similar to what we had over here. A gap, and it closed the gap. Here, the gap is open. Usually, if you're going to trap the bulls, you do not get all the way up to the breakout point, the 50 low. So it makes me think that we're going above the 50 low, especially since we're right at the 60-minute moving average. Strong enough bear breakout, so the odds favor slightly, at least a little bit more down. But I think probably not a lot more down. I mentioned GE the other day. Let me take a look at it. I haven't looked at it since early today. Look at that. That's really, I think, fascinating. GE came out with incredibly horrible earnings on Friday, yet the market rallied strongly. And when the market rallies strongly on terrible earnings, that is a bullish thing, because it's traders concluding that the earnings cannot get worse and therefore they have to get better. And if the earnings have to get better, the price should go up. And then GE talked today about cutting dividends, and the sell-off today is probably incorporating the expected dividend cut. A lot of people buy stock like GE because of the dividends, and if the company cuts the dividends, a lot of people say, well, I only owned it because the dividends were high, and now the dividends are lower, I don't want to own it. This is GE. Dividends right now, 4%. Here's the dividend yield. So 4% dividend, and which is attractive. But when they cut it, a lot of traders are going to say, heck, I'll own it if it's paying me 4% a year, just staying flat. But if it's paying me less than that, I don't want to own it. And that's probably what's causing today's sell-off. Daily chart, E-mini. This is, I believe, the most overbought the E-mini has been, E-mini's only been around for 18 years. I think by at least the measure of the weekly moving average, this is the most overbought the E-mini has, or the S&P 500 has been in at least 50 years. While it can always get more overbought, it's unlikely to get much more overbought. Anybody going to buy with a stop above 61? I do not think so. I would not. Anyone going to sell with a limit order at the 60 high? I would not do that either. Right now the market is so close to going outside down that chances are there are buyers around where we are. 60-minute moving average, yesterday's low. Even if we get below yesterday's low, we're probably not going to go much below it. Usually outside days do not go far below the low of the prior day. Sometimes they go the same distance that they went above. And you can see we went 9 ticks above. And therefore, if we do go below yesterday's low, we probably will not go more than 9 ticks below. Right now, we're setting up a possible island top for tomorrow. A gap up, and then 2 days sideways with the bear day reversing the bull day. So normally a minor reversal, but because the weekly and monthly charts are so overbought, there's a higher chance that it will be the high for the next several months. In other words, higher chance it's a major reversal. So if we gap down, I'm not saying we'll go straight down. We may go sideways like this for a month or two, right? Like this. However, there's a higher probability that this will be the high, or the high is not much higher. So I don't think the upside is very great from here. Okay, the market's ignoring that measured move target. I'll get rid of it. This is the key price. Usually when you break above a very important price like that and then reverse up after only falling a couple ticks below it, you have to test it again. And therefore, I think there's probably an 80% chance of coming down here within the next several months. And that's about, it's not quite 100 points, but it's close to 100 points down. And chances are we'll go below it. So I think we'll get between 100 and 150 point correction starting soon. Maybe starting today, I don't know, but certainly starting in the next month or two, because the weekly and monthly charts are historically overbought. A low one short, but not a lot of traders going to sell below 60. And probably buyers around the 60-minute moving average, buyers around yesterday's low. So probably going to have a hard time getting very far below yesterday's low. We have a potential measuring gap, but measurement from where? Are we going to do that? Are we going to come all the way down here today and close the gap? Not likely. The sell-off is just not all that strong. An II and an IOII, but a pair of bear bars. So a lot of traders will not take the stop entry buy. Bulls trying to prevent the market from going outside down. Some bulls will buy above 60, closing on its high. For the bears, I don't know, I would not sell. Limit order bulls who bought a point below 50 made their 1 point scalp. For the bears, micro double top, close the gap. Probably buyers below the low of the day at the 60-minute moving average and at yesterday's low if we get there. It looks like a lot of the bulls who bought 1 point below 50 scalped out and went one tick above, and then it sold off. That's about a 50% pullback of this final sell climax, and it's also where the bulls will sell out of their longs. They're scalping. They're not confident that this is a major reversal. They think it's a minor reversal. Like every other reversal today, every other reversal was minor. It became a bear flag, and we simply continued down all day. Bears are hoping 62 is like 43, but I would not take the short. We're right above significant support, the 60-minute moving average and yesterday's low. So probably not going down very far. And I probably would have bought above 62 if it had a bull body, but it did not. I'm flat. I don't want to be selling at the low, and I did not sell the 50% pullback. I obviously did not buy, but I'm flat. We're in, I think, an important support area, 60-minute moving average, yesterday's low. So probably not falling much further, but we might fall below yesterday's low. 15-minute chart, endless pullback. We get a reversal up and down, and it kept trying to create a bottom, but it ended up in a very tight bear channel. Double top here and here. There's the neckline, and we're just above the measured move. There are all kinds of reasons for support, but the bulls have been unable to get a convincing reversal up from support, and the bears keep selling every rally to around the midpoint of the prior bear leg. So here's a bear leg, bulls sold around the middle. A bear leg, bulls sold around the middle. And the same with here, and the same with here. Bulls trying to get a good bar up from support, bottom of the channel. I don't have the line extended all the way down, but it's the bottom of a channel. And we're at the 60-minute moving average, and the bulls are trying to prevent it from going outside down below yesterday's low. This happens commonly where the market trades above yesterday's high, trades down to yesterday's low, and then reverses up from just above yesterday's low and does not go outside down. So this could be a decent buy setup, but the bulls want the bar to close on its high. Two-tick tail, a lot of traders will not take the buy. So the close of this bar is important. If it closes right on its high, I think that would increase the probability. One-tick tail, it leaves some confusion, but it would still be pretty much the first stop entry buy that I would take all day. But two-tick tail, I would not take the buy. The bulls did, I think, the minimum, right? We got a second leg down from this breakout. We're at support, the bottom of the channel, 60-minute moving average. Can you buy for a swing or a scalp? You can always buy for a swing. Higher probability to wait to see if we reverse up strongly and then buy. Is the probability good enough for a scalp? It's pretty close. It might be okay for a scalp. Usually, when you have a bear trend day, where it's very difficult for the bulls to make money all day, you get one stop entry buy sometime after 11 o'clock. And, this could be it. And the opposite's true of a strong bull day where it's hard for the bears to make money. Usually you get one stop entry buy that's good enough for a scalp later in the day. The bears are still hoping to get below yesterday's low. But I think the always in bears get out here. And the bulls, I think they can buy here. Sometimes you get a very, very big reversal up. But after selling off for 64 bars, 65 bars, I think we probably will not. Okay, went above yesterday's high and sold off strongly, but right above yesterday's low they bought, and they prevented it from going outside down. Went above yesterday's high, reversed all the way down to just above yesterday's low, and they bought, and they prevented it from getting outside down, and we got a good bounce up. Once the bears decided they could not get outside down, they gave up. So there's a chance of a fairly sharp reversal here. Went above yesterday's high, sold off, very tight bear channel, and right above yesterday's high, we got a micro double bottom, and then we rallied for the remainder of the day. Again, all of these, this is earlier in the day, but the idea is still the same, that a lot of times, if the market sells off for a long, long time, or very quickly, but then reverses up from just above yesterday's high and prevents the market from going outside down, you'll get a reversal. Here's an outside down day. Right at the end of the day, it went outside down. It held above all day long and then collapsed below yesterday's low at the end of the day. Collapsed outside down day, yesterday's high, yesterday's low, but even then it still reversed up. Sold off strongly below yesterday's low, double bottom at the end of the day, reversed up. So you can see, even when it does go outside down, usually, especially if it's late in the day, it does not go a lot further. If you get outside down early in the day, especially if yesterday was small, you can get a big bear trend. But if yesterday is an average type day, like Friday, and you go outside down, usually you're not going far below. Outside down did not go far below. Outside down went fairly far below, 10 points, but still reversed back up. Outside down, sold off strongly. They still bought it twice, double bottom, reversed back up. So outside down usually does not lead to a big move below the low of the day. I'm going to take a look at ticks. Now, that's interesting. Got a new low in the E-mini, another new low in the E-mini, but ticks formed a higher low and then a higher low again. So there's a tick divergence, and that means that even though price is going lower and lower and lower, fewer stocks are going down, and that usually is a problem for a bear trend. You don't want fewer stocks going down as the market goes down. You want the entire market to go down. All right, so the bears want a breakout pullback short. For the bulls, stop below 65, but if it falls below 65 and reverses up, they'll buy again. And I think a lot of the bears are not going to short below 67. I think the always in bears get out above 65, and theoretically they have to sell again below a bear bar, which might be 67. But unless it closes on its low, I think most bears will not take the short. I still think the setup is more likely than not to lead to at least slightly higher prices. Do we get it all the way up here? Is it a spike pullback channel? I don't know. It's pretty far up. Maybe we'll get there. I don't know. It's 4 points up on a pretty quiet day. And as I said, even if the bears do get below yesterday's low, and even if they break strongly below it, the odds are against it going down all that far. So here we collapsed below it, and it reversed up, and then a double bottom, and in the final few bars of the day went up pretty quickly. They're hoping it's a bear flag. Double top 63. You can call it a triangle, even though it does not have a triangle shape. I think it's a tough short. We have a decent buy, 65. We're probably not going to go far below 65, even if we fall below 65. But theoretically, if you're trading always in short, you're selling. I would not. And for the bulls, they have to decide, do they get out below 67? Do they keep a stop below 65? Or do they use a wider stop, like a 4-point stop, and then scale in lower? I think all of those are reasonable. Key support. Odds are we bounce here or just a little bit below. Small chance of a collapse and closing the gap above Thursday's high. It's real. It's a real chance. We could just get down below this high on the daily chart and close the gap and turn it into an exhaustion gap. That would be good for the bears. It would increase the chances that this was a final climactic blow off. I talked about how when a market is this overbought, it sometimes has a blow off top. It just keeps going up and up and up and up and up, faster and faster and faster, and then it stops going up, and the momentum traders start selling out. A lot of times after a climactic top, it goes sideways for 10 bars or so before it goes down, but a climactic top can lead to a reversal. Not a good double bottom for the bulls, 68. Not a good sell for the bears, 67. Market's deciding whether it's going to get below yesterday's low. Only one tick overlap, so it's a possible measuring gap, but unlikely to fall for a measured move based upon that. Maybe it'll fall for a measured move based upon this. Bears selling above every bear bar and in the middle of the most recent bear breakout, but we're at, I think, major support, 60-minute moving average, and the low of Friday. So not a great looking short down here. And I think not a great looking short below 67 either, even though it's a double top and a bear trend. But the bulls are not getting a reversal. They tried 68 and failed. Outside down and accelerating downward, but probably not going much lower. There's still a chance that we can close the gap and fall below Friday's high. I am flat. I'm not selling down here, and I need a good bull bar to buy, but with this many bars down, I'll probably wait for a second entry buy. And we might run out of time. For sell to close, this is starting too early. Usually if it starts much before 12:30, it does not make it to the end of the day, and you'll get a reversal. This one started at 12:15. Today we're starting at 12:05. Here at 12:15, it did make it to the end of the day. 11:55 did make it to the end of the day. 12:35 did. 11:55 it did. 12:05, like today, reversed up. 12:10 stalled. 12:30. 11:20, big reversal at the end of the day. I would get out of shorts. It's unlikely to go down much further. And we have a bull body. Typically, if you have a sell to close finish in a bull body, it's better to get out of shorts. We're at support. Friday's low, outside down, a 60-minute moving average, and then the bottom of a channel. The channel is getting increasingly steep, but I'm flat. I would get out of shorts and possibly not sell again. And the bulls have a problem. They only have a one-tick bull body, and they have 5 bear bars, so not a lot of bulls willing to take the buy. Bulls trying to get an ILI for a second entry buy. Today looks a lot like this, a fairly tight channel. At the end of the day, a little bit of profit taking on the part of the bears. I am flat. I say that, but I'm flat, the E-mini, but I'm holding puts and put spreads. They were profitable as of Friday morning, but now they're negative, slightly negative. Impressive, very close to closing the gap above Friday's high. The VXX, which is basically a leverage version of an upside down E-mini chart, accelerating up. Here's a 4-hour chart, very tight channel. Here's a daily chart, just selling off forever around a measured move down, not quite. Now, parabolic wedge, 1, 2, 3, but stop order bulls have not made money at all today, so traders are hesitant to buy. However, the context is good for profit taking at the end of the day. Can we get all the way back up to the, where did my number counting go? Can we get all the way back up to the 50 high? I don't know. It would be good if the bulls do that, but I'm not sure that we'll get there. That's a lot to accomplish in just the remaining few bars. Bears, I think the bears get out above 72. If they sold again below 73, they have to get out above 75 and probably not sell again for the rest of the day. And the bulls are hoping that this parabolic sell climax reverses. They want to get back as much as they can. They want to get above Friday's low. They want to get above the 60-minute moving average. They'd like to get all the way up to all of these highs, but very unlikely that we'll get all the way up here. We might get here. Limit order. Scale in bulls who bought the 65 high might have bought more. Well, they probably bought more above 75, and their average price, they buy one tick above here, so they got long here. They buy more one tick above here, so they get long here. This is their average price, and some of them, since it's the end of the day, might be happy simply avoiding a loss, and therefore they might get out right here. They are long here, they buy more here. This is their average price. If it gets one tick above that, they can sell out and avoid a loss. They'll lose some here, they'll make some here, and they'll get out break even on the trade. So probably some sellers right around that average buy price. As I said, even though the bears might get another sell signal, double top 73, and they still have a magnet below the bottom of the gap, Thursday's high. I think a lot of the bears will not sell anymore today. And that relative absence of traders willing to sell can cause the market to go higher in search of sellers. For the bears, double top 72, I would not take the short. I would just wait for tomorrow. I think you get out above a pretty good bull bar like 75 and then just wait. Bulls trying to keep the gap open and trying to get a double bottom. A lot of times at the end of the day, you'll get a bounce with a decent buy signal bar. The bulls are still, I think, long from above 75. The bulls who are not long might try for a scalp above 78 if it closes on its high and has a 3 or 4 tick bull body. But anything less than perfect, I would not do anything. really pretty interesting day. We just sold off in a fairly tight channel, but it was never really a small, it was a small pullback bear trend day, but it was not the typical type of small pullback bear trend day. I was watching for over here, would we close the gap below 18? And if we close it by 2 or 3 ticks, usually that means that we're not going to have a small pullback bear trend day, and we close by 3 ticks. Yet we sold off below a failed breakout above the triangle bottom, and closed the gap over here below 46 and 27. And limit order bulls were making money, buying a point below 18 and below 27. And that's not what typically happens in a small pullback bear trend day. And we had a breakout here. This is pretty late in the day. A 1 tick negative gap. This went 1 tick above that low. It's always possible that we're going to measure move down, but we're right, I think, above major support, 60-minute moving average, and Friday's high. So I thought that it was not going to be a small pullback bear trend. It was a tight bear channel, and it ended up being a small pullback bear trend, but not a typical type. Pullback here lasted 15 bars and went 3 ticks above the breakout point. Here we went several ticks above the breakout points, and limit order bulls could make money, and those two things usually do not happen in typical small pullback bear trends. But this was a small pullback bear trend. It just kept going down and down and down. The bulls had a reasonable buy above 55, but the bears got their double top. You can call it a low 2 below 67. I think the bears get out above 65. Technically, they have to get short again below 67, a bear bar and a second entry short, but we're right above the 60-minute moving average and the high of yesterday, the low of yesterday, Friday. So for me, I would not take that short, and I ended up not doing anything all the way down here. Daily chart, we try to get a top here. This is a type of consecutive tops. The market, this is an unusual top. We have daily chart, extreme climax, extreme breakout above the top of a bull channel up to a measured move target. And following this big breakout, we have a small wedge top. So that's a top. We gapped down and the top failed. We immediately reversed up. And now we're trying to top out again a second time with an island top. So this is a type of consecutive tops pattern, and the location is good. Here's the weekly chart, and the measured move target is right there at 2577.5, and we got to within a few ticks of that today. So we're close enough. My main concern is the weekly chart has never been this overbought in the history of the E-mini, and the monthly chart has only been this overbought once in the past 50 years, and we're 12 months without a pullback on the monthly chart, and the only other time it got more overbought than this was 13 months, and it pulled back about 5% after that 13th month. If we fall back 5%, right now that's about 120 points. That would take us somewhere down here, bottom of the channel. I think there's a high probability, I don't know what the percentage is, 70 or 80%, that we're going to close the gap between these lows and this breakout point sometime in the next few months. And I think we're going to get down to this low. We tested the August high, just dipped a couple ticks below it and then exploded to the upside. And usually you need more of a test than that. And whenever a test looks too minimal, it usually has to get tested again. And therefore, I think we're going to come down here sometime in the next 1, 2, or 3 months. Again, that would be about 100 points down. I think we'll fall below it. So I think a minimum reasonable target will be 100 points. Everyone's talking about 3% or 5%. This line And these lines, this is about 3 to 5%. 5% is probably closer to the bull trend line. We gapped up on the open, and that is a gap on the daily chart and the weekly chart, and we immediately sold off. We had consecutive bear bars, so in the close of 2, I think we're always in short. But because 2 opened on the high of the day, I'm going to check that on my other computer and see if the CME changed its price. I'm looking on my other computer. CME, I've never seen them change the price. TradeStation will change prices because they get their data from the CME and it's sample data, so they don't show every tick. And the CME, in fact, this is correct. The day did open on its high, and the open remained the high of the day for the rest of the day. So that's a once a year event. So if you look at the daily chart and you look at every day over the past year for how many times the open of the day is exactly at the high of the day, I would not be surprised if this is the only one. You know, we had a couple of attempts here. Let me just check. The high is 1 tick above that bar. The high here is 1 tick above the high of the bar. So even though it looks like the high and open are the same price, they're not. Usually the market will go at least 1 tick above the open. And it's rare, pretty rare, once a year or so, that you get the open remaining as the high of the day. And it looks like today is that day. You know, just looking back over the past year, I don't see any other day that is a candidate. You know, this is last year. Let me check this. Okay, here's the last time it happened. You know, about a year ago. The high of the day is the open of the day, and it remained the high all day. So pretty unusual. Because it's unusual, the odds early on were that we would get above the high of the day, and we did not. I said that we're always in short, close of 2, probably sellers above 3, but because the high opened on the high of the day, there was a magnet up there, and we probably had to get above it. So we might get above the high of 1, but whether or not we did, there probably would be sellers up there. The bulls tried to get a wedge bottom at 12. And too many bear bars, 6 bear bars and only a 1 tick bull body. Better to wait for a second entry buy. And then 18, we had a failed breakout below the wedge, and now we're forming a bigger wedge, but 3 consecutive bear bars, not ideal. And the bulls got a 4 tick trap. And then over here, the bulls again tried to get a failed breakout below a wedge bottom and 4 consecutive bull bars, but did not go up very far. And the bulls got a 4 or 5 tick trap. And all day long it was like that, same thing. Possible final flag and bull reversal, and they were trapped. Bull reversal, they were trapped. Bull reversal, trapped. Bull reversal, trapped. And the only time the bulls, stop entry bulls, made money was buying above 3. And I said at the time, nobody's going to take that buy. They want to buy above a bull bar, not after 3 bear bars. And stop order bears, it was really not all that easy early on. If you sell below 6, you got a 2 tick tail, 2 tick bear body, probably a trading range. You'd probably buy back above 10 or 12, so it'd be hard to hold the swing short. And selling below 14, you got a 5 tick trap. Selling below 24, you made money, but would you hold once you see 27 or 34? It'd be hard to hold. Whether or not you held or if you get out, if you're trading always in short, you probably had to sell again below 24, and a lot of the bears would get out 2 legs up, 1 pullback 2, and they have to sell again 53 one tick bear body, probably not good enough. 56, a doji, not good enough. And then 57, a tail, big bar, selling right at the low of the day, not all that great. Maybe the next short would be below 67, and the market is right at critical support. So I think it was pretty difficult to get short, and I think it would be very difficult to hold a swing short. But that's true of all trends, all relentless trends. There's always a good reason not to swing trade them. And there's always, they always look like they're forming wedge bottoms. They're always at some kind of support. They're always decent buy signal bars, so it always looks like the market's going to bounce at least enough for a scalp. Yet bulls continue to get trapped and bears continue to sell about halfway up from the most recent bear leg, and they have to be patient. So we got a bear leg here. Here's the midpoint. Bears sell and stop up here, and they just keep trusting that as long as they sell around the midpoint of the last bear leg, put a stop above, it'll continue to form lower highs and lower lows. They know the odds are against it. However, they also know that if they do it consistently, some days they make a little, some days they lose a little, but sometimes they make a lot and they never lose a lot. So it's a good strategy, even though most of the time you don't make much. Most of the time, small wins, small losses, but sometimes you get a big win. And today was an example of a big win. Buy the close, sell the close. Well, 2 and 3 close or sell the close. But as I said, we might go above the high of 1 to stop the open of the day from being the high of the day. And that was pretty much it for buy or sell the close until down here. And, 69, 70, 71. For me, in general, I get out above a bull bar, 72, or I get out 3 or 4 ticks above any bar, whether it's a bull bar or a bear bar. Sometimes, although this time I didn't trade it, sometimes if I'm short, I will not get out above a 1 tick bull bar. I'll place a stop order to get out 4 ticks above, and I will get out above a decent bull body like this. I'll stop and get myself stopped out 1 tick above the high of the bar. Limit orders, it was interesting, limit order bears are selling the midpoint of the most recent bear leg. And it's hard to do because to get to that midpoint, the market keeps forming bull bars. And it's hard to be selling when you're seeing these bull bars. But from a swing perspective, the math is okay. Most of the days are not like this. Most of the days, that strategy is a losing strategy. But not much. You never lose much. Most of the time it's break even. But sometime you get a big sell-off like this. Limit order bulls made money. Not a lot. But buying below 12, scaling in lower, buying below 27, scaling in lower, even buying below 50 and scaling in lower, they made money, even though that was the start of a collapse. Buying below 65, they lost. Usually in a small pullback bear trend day, the bulls have a losing limit order trade much earlier in the day. Usually the first 2 or 3 hours, there's a setup, you get a gap, where the bulls have bought the 65 low, and scaled in lower, get trapped, and the market keeps going down. So usually this happens somewhere over here. It's unusual for the first time for it to happen 5 hours into the day, but that's what it did today. You can ask why I have been buying puts and put spreads, and it's because of stuff like this. I personally don't want to be shorting at the low when a trend looks like this. So I take, some limit order shorts that are higher up, but never as many as I want. Yet, as a fail-safe measure, in case this is the start of a swing down, given how overbought the daily, weekly, and monthly charts are, I want to be in a position to make some money. And the math is okay. Especially if you buy put spreads that are far enough out, January or February. The way I look at it is this. Let's say you buy, let me put up the spider and talk about it. So here's the spider. Let's say 256 right now, right? So let's say you buy a 255, 245 put spread. And you say, well, wait a minute, Al, there's no way it's going to fall all the way down here. That's right. If you're buying a put spread, you're buying this put and you're selling this put, you don't want it to fall below this price. But you're trying to pick a price where it's near support. The bottom of a channel, the 150-day moving average, and prior low, right? So you pick the short put somewhere around a support level, expecting that it's not going to fall any further than that, right? So let's say you buy a 255 put and you sell a 245 put, and I don't know how much you have to pay for that right now. If you're in January, maybe you'd have to pay about $2.40 or so, all right? Let's say 250. So you buy a put spread, you buy the 255, you sell the 245 January spider puts, and you stand to get $10. If the market in January, when the puts expire, if the spider is below 245, the short put, let's say it's right at 245, right? The short put expires worthless, and the long put you make $10, and you pay $2.50 for it. And you say, wow, that's good. I make 3 times more than I lose. So I pay $2.50 and I make $10, but I paid $2.50, so my net profit is $7.50. So I net out $7.50 while risking $2.50. So my reward is 3 times my risk. All right. So what does that tell you? So that means there's an institution who sold that to you. So they did the opposite. They're buying the 255 put and they're selling the they're selling the 255 put and they're buying the 245 put. They're doing the exact opposite of you, and they're doing it because they know that they are probably going to be right and that you're probably going to be wrong. What is your chance of having the January spider close at 245 or below? Well, it's easy to figure out from what I just said. You paid $2.50 for a put. Your net profit is $7.50, so 3 times your risk, and that means that the probability of you making money is probably 1 chance out of 3 or 1 chance out of 4. You can say that the total profit is $10. The gross profit is $10. Your cost is $2.50. But somewhere around there, that you only have a 25 to 33% chance of the market closing down here. So right now, anyone buying that put spread has only about a 25% chance that when the January put expires, that it's going to be at 245 or below. And you can say, well, Al, how can I make money? You said I make $10 if it closes at 245 or below. And you're telling me there's only a 25% chance it's going to close there. That's terrible. The probability is terrible. But that's not the point. The point is, can you make money? Not can you make $10 risking $2.50. And the market does not have to close down at 245 to make money. If you buy a 245 put spread and you pay $2.50 for it, as long as the spider closes $2.50 below this price in January, you make money. So $2.50 less than $2.55. That means as long as on the 3rd week of January, when the put expires, if spider is below 252 and 252 and a half, right, then you'll make 250 on your long put, and you get to keep all the money on your short put. So on the trade, you'll break even. You'll end up with total profit of 250, and you paid 250. So your break even is not all the way down here. It's at 252 and a half. So if you pay 250 for the put spread, when the puts expire in the 3rd week of January, if the spider is anywhere below here, right here, right, you will make money. And if it's down here, you make $2.50. If it's down here, you'll net $7.50 times 100, so that's $750 for every put spread. Every put controls 100 shares of the spider. So I don't know if I'm being clear, but that's my thought. So right now, I have different things on, but one thing I have on is a 255, 245 put spread, and as long as and my average cost, I don't know what my average cost is. It's probably it's less than $3. I think it's like 280. I'd have to figure it out, but it's less than $3. So as long as it closes somewhere around here in January, I make money. And if it falls anywhere below here before the third week of January, I'll start to make money. Obviously, if it trades down here and just goes sideways, I'll have to decide whether to get out with a small profit or hold for a move down here. But, right now it's too early to decide. Normally, when a trend looks like this, I ain't buying puts or put spreads. And if anything, I'm buying calls or call spreads. But because the weekly chart and monthly chart are so unusual, I think it's more likely that this is going to be an exhaustive end of the trend than it is the start of a new rally. You hear people on television arguing, the Trump tax cut is not factored into the price at all. The market doesn't know if the tax cut is going to take place, and therefore it's not discounted. And once the tax cut takes place, the market's going to go way, way up. I think that's ignorant. That's foolish. You hear some pretty smart people on television make that claim that it's not factored in. Obviously, a whole bunch of computers have factored it in. Others may not have factored it in very much, but the institutions are not stupid. It's not either it's fully factored in or it's not factored in at all, right? It's almost always going to be partially factored in, and we don't know if it's mostly factored in or not factored in much at all. My guess is the institutions are adjusting their opinion every day and trying to stay hedged, trying to stay as neutral as they can be. So the tax cut is factored in to an appropriate extent right now, but nobody knows if that means it's mostly factored in. In other words, when the tax cut comes, we're not going to go higher, or if it's not factored in much at all. In other words, the institutions are betting against a really good tax cut, and if we get one, then the market has to reprice. It has to go up much higher. Because the weekly and monthly charts are so historically overbought, I believe that the tax cut is already factored in or mostly factored in, and therefore I think we're not going to go up. I'm holding put spreads. That's telling you that I think that we're going down. And I keep saying about 100 points. It might be 200 points. So that would be 20 handles on the spider. It doesn't seem likely that we'll get down here by January, but we could get somewhere down here in January. If it gets here, my put spread doubles in value. If it gets here, it quadruples in value. So I'm thinking that we'll probably fall somewhere down here, which corresponds to those targets here and here. Okay, questions. If you went to long and the stop is far away, and then 3 consecutive good bear bars come, do you stop out for a loss? Yeah, that's in general, especially if the market's in a bear trend, right? If it's in a bull trend, let's say it's in a bull trend, and I was long on Friday's close. Let's say I was not, but let's say I was, and I got 3 bear bars. I'm getting out. I might get out, try to get out with a limit order above or a 50% bounce. But when I see that close, I'm pretty much going to get out, and even more so in a bear trend. So if I'm long here and I don't get out below the low 2, low 1, low 2, and I see 2 bear bars, I'm usually going to get out. If I see 3 bear bars, there's 0 chance that I'm going to be holding long. I'm always, 100% of the time, going to be getting out. I'm not, 3 bear bars closing near their lows, closing below their midpoints. There's no way that I want to be holding long, especially if it's in a bear trend. I don't care if it's climactic. I don't want to hold because climaxes can become much more climactic. Al, can you show us how you use tick and volume a day like this? I'm not a big fan of ticks and volume, right? And I rarely ever look at them. And when I do, it's usually on a 1 minute chart during a sell climax. I have friends, one in particular, who uses ticks and volume all the time, but I don't. But anyway, this is the 5 minute chart. Sometimes when the market's in a series of sell climaxes, I'll look at the ticks to see if the ticks are forming higher lows while the market's forming lower lows, and especially if there's very climactic volume and then the volume is getting less, and that's not the case with volume. Ticks forming higher lows, prices going lower lows, but the volume is not climactic over here. I want to see the first volume spike be huge, and then the next volume spike be less huge, and the third one less huge. So in addition to ticks, I want to see the volume drying up as well. As the market's going down, I want fewer stocks going down, and I want the total volume going down, which means that there are fewer stocks and fewer traders willing to sell low. And again, sometimes I'll look at it on a 1 minute chart. If I feel like I want to buy a sell climax on the 5 minute chart, and I'm thinking about entering early, sometimes I'll put up a 1 minute chart and look for both a tick divergence and a volume divergence and take the buy. You know, I have a sample of that in the course. I don't know if I have a sample of it in my sample slide. I don't think that I do. No, I should create one. Let me do that. Let me make myself a note. Okay, so I'll leave myself this note to look for an example, and I'll put it in here just for future reference. Okay, question. Did you say that only once a year the high of the day remains, that the open of the day remains the high of the day, and all the other days go above the high at some point in the day? That's not go above the high, go above the open, right? There are a lot of days, you know, maybe not a lot, but maybe 5 times a year, you'll get a day like this that opens on the high. And of those 5 times, 4 will go back above the open so that the open will no longer be the high of the day. Only once a year, about once a year, the open remains the high of the day for the remainder of the day. So I may have misspoke using open instead of high or high instead of open, but let me be clear again. About 5 days a year, the open of the day is the high of the day for the first bar or two. However, 4 of those 5 times, the market will rally back above the open, which is the high, so that the open is no longer the high of the day. Only once a year does the market open on the high, and the open stays the high of the day for the remainder of the day. Okay, I'm losing my voice. Hope everybody has a good night. Tomorrow could be really, really interesting. The next few weeks can be really, really interesting, you know, because of how exceptional the weekly and monthly charts are. I keep talking about it. I don't hear anybody on television talking about it, but it's really, really, really unusual. So we'll see what happens. Okay, hope everybody has a good night.